Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the man, myth, the legend, Mr. Greg Dickerson. How you doing?
Doing great, Michael. Good to see you.
Oh man, one thing I knew I had to talk to you about is Cathie Wood. Cathie Wood is out with a new story. She's basically saying deflation is around the corner, and most importantly for you and I, she is saying the Fed is going to pivot in July, like 5 weeks from now. The Fed is going to pivot. She's obviously saying this because a Fed pivot in July her stocks would go to the moon and all of these things. She's talking her book. I think she might even believe it, but can you imagine the Fed pivoting in 5 weeks? I mean, I just can't imagine.
Well, they can't. So she's talking desperation. She's not talking her book. She's not talking what she thinks. She's just desperate. And it's the only thing that can save her and, keep redemptions from happening because, her 5 to 10 year outlook now, instead of 80% returns or whatever she's talking about, that she dropped to 40, that where she's at now, I think is break even. The problem with Cathie is, and she's obviously been successful before and had, ups and downs and things like that. The biggest mistake that firm made, she touts their research and the quality of it and how she gives it away. And that's what sets her apart, is the level of their research. I've never, ever heard once or seen any risk management at all in any of their research. All you see is innovation, exponential, 80% returns. She gets paid to manage money.
Yeah.
She doesn't get paid if it's making money. Well, I mean, she gets a split, but she gets paid whether you're making money or not. So if you throw $1 billion in her fund and you lose it all, she still gets paid.
Yeah.
So, what attracts capital? Bull market. That's how you attract capital. I'm a bull, man. Market's going up. It's never coming down, exponential. But that's the biggest mistake they made, is they never talked about risk management, meaning how do you preserve your capital? How do you hedge against the downside? Because they don't have risk management and they wrote it all the way down. And, the only thing that's going to generate, a V-shaped recovery or a snapback is the Fed pivot, but the Fed can't pivot. And we'll talk about that next.
Yeah, I think you're absolutely right. I mean, I actually think Cathie is one of the best marketers in the stock game that I've ever seen. For years now, she's been talking about this 5-year horizon, all technologies deflationary, all of that. She's basically in that message. What I've taken from it is, don't look at my monthly, quarterly, or yearly track record. We're playing for 5 years. So put your money with me, come back and check in 5 years. We're all going to go to the moon. And I've been through this cycle before. There are companies in her portfolio that will go to zero. Some of them will be sold for parts and pennies, and a couple of them will hit. That's just how it works, right? She essentially has a portfolio of mainly companies that were priced on revenue, not profit. Many of them not really changing the game. They're using different, legal loopholes and stuff that can be easily copied. There's no technology moat. And you're right. I do think this was a desperate move. I think she's looking at more and more of her portfolio going down, down, and down. I think she's down 50% or 48% for the year. She had a little snapback last week. And I think she's like, I got to tell people, I got to get people to hold on till July. If I can get them to hold on to July, maybe I can get them to hold on until September. And yeah, I think she's desperate right now. Because I can't even fathom the Fed pivoting in July. I mean, really?
They can't. It's not even a matter of imagining, fathoming. They just can't. And we'll talk about that why in a second. But, so Cathie is right. You can have a 5-year, 10-year horizon if you start at the bottom.
Exactly.
If you start in 2009, March. If you start in, oddly enough, March of 2020, it was March 2009 was the bottom, March 2020 is the bottom of the last two big cycles that we had, or at least on major market pullbacks. You don't call for a 5-year, 10-year horizon at the top of the market, all-time highs, when the only reason you're there is because you have a 40 to 100x PE ratio on
revenue
potential, pro forma adjusted earnings based on perfect conditions, not even actuals. Not, hey, if we maintain a growth of 1 million users a month, and if we become profitable at some point, maybe, and if that, that's what those projections are based on. And it's because, why is that? Because there was so much liquidity out there being pushed into risk assets. That's what the Fed did. When they pumped $2 trillion in the economy, all that money got flooded out there. So, the yields dropped so much that investors had no choice. They had to go into risk assets. And they all knew there's a bubble. And as soon as the Fed stopped, the only thing that we didn't have, like in 2018, everybody's saying the Fed's going to pivot just like 2018 because markets are going to crack or whatever. We didn't have inflation.
Yeah.
The Fed could pivot back then. And what broke were the credit markets. The reverse repo market was breaking. And that was when QT started the last time.
Correct. Yeah, correct.
So, that could potentially happen again, but the Fed can't pivot this time because why? Because you have inflation that is so high right now that that's a worse outcome for the economy than the market going down, 75%. Yeah. That is a worse outcome, is inflation not being controlled. And if they pivot, it won't be this fake 8.3% number that they ran last time, which we all know there's no way inflation is only 8%.
Oh,
there's no way it came in less last month than it did the month before. I don't even know how that happened.
Yeah.
And there's absolutely no possible way, if you're actually working real numbers, that it's going to come in lower this Friday than it did last month, which everybody's expecting.
Yeah, it's funny. I actually called to go back up, and I'm like one of the rare, economic guys talking about, because I think it's going to go back to 8.5. A lot of the stock guys I have a guy on Sunday and actually a guy later today. Both of them are like, dude, CPI is going to 8%. I'm like, are you kidding me? Have you seen food?
Peaked. I don't know what they're looking at. I don't. Everybody watching this, have you seen any prices go down?
Yeah, I haven't. I mean,
nothing is going down. It's going up except for their number. That's the only number going down. And I don't know what they're looking at.
Yeah. So again, there are a couple of things that I think will go negative. And I think the one that Cathie Wood will hold on to is there's two: close. And again, close makes sense, right? You triple ordered, they're sitting on a dock, they showed up at the wrong season. So you got to blow them out. I get it. Okay. So close, which close makes up like 0.08% of CPI. It may be used cars. Used cars are off a hair from their crazy numbers, but gas is up, food is up, new cars is up, airline tickets are up, hotels are up. I'm like, how can this go down?
You're not measuring anything that people need. You don't have to have new clothes.
No, you don't.
You don't have to have a new car.
No.
Yeah. You got to have food. You got to have housing. You've got to have electricity. And here's the big one. So a lot of people aren't even thinking about her July or whatever. Energy this fall and winter. Oh. You talk about an inflationary shock to the system. People that have to heat their houses with heating oil, liquid propane, things like that. That stuff's going to be a fortune. Yeah. If fuel prices, oil and energy prices don't come down. And that doesn't look like that's going to happen anytime soon. I mean,
no, it doesn't.
It's just gas is continuing to spike everywhere. Oil, heating oil, it's not a thing right now, but it's going to be.
It's going to be
fall and this winter. So these are the things that the Fed is looking at. And yeah, used car prices coming down a little bit. I mean, that means nothing. They were way overblown anyways.
Yeah, agreed.
Housing has not come down. Rents have not come down. They're continuing to spike in areas. The only thing that's adjusting a little bit is, like real housing prices, but then your taxes, your insurance, your heating, your electricity, your maintenance, all that's gone up because who has a yard care person who hasn't raised their prices, or a house cleaning person who hasn't raised their prices, or a handyman, or a service that's delivering, or whatever it is. Everybody's putting that, fuel surcharge, inflation surcharge. Restaurants, they have an inflation tax that they're adding onto the bills.
I've seen it. Yeah. Yeah. And let's not forget diesel.
Yeah. Just take a look around at what the traffic looks like in your area. People are not driving now because of gas. They're walking, they're taking transportation or working from home. People aren't out at scale, eating out, things like that. So those are the first things that get cut back is, travel, eating out, movie theaters, things like that. Clothes that were over ordered that we don't need anyways. I mean, I buy shirts, once every 3 or 4 years when they go on sale,
Yeah, no, exactly.
I mean, I buy very nice shirts, but I wait till they're like 75% off and I buy a bunch of them,
Exactly. I'll buy 4 of those and 3 of those. Yeah, totally get it. Yeah. So Friday's going to be a big number. If they manufacture fake cajole, whatever the number, and it comes in below, like if it comes in at 8 or whatever, the stock market's going to have a nice bounce. I think it goes up. And I think
it already is. I mean, that's what they're anticipating today. I mean, markets are up today because they're anticipating the narrative inflation is peaked. Yeah. So when you hear that narrative coming out of everybody on Wall Street and the markets are up ahead of the inflation read, guess what they're doing? Setting the table, trying to get some, exit capital so that, when the print comes in and the market tanks, because they know what the Fed's going to do. And that's the other thing is that this whole thing, inflation's peak. So the Fed, is going to ease up. They're not going to pivot, but they ease up. That's not going to happen. The Fed has got to get after inflation because they know if you've got clothes sitting on the dock, you got to cut prices 50% to get them sold. That's not an inflation measure. That's over inventory that you have to reduce and get rid of.
Yeah, exactly.
Everything else still costs more every single day. And even kids are seeing it. And when your kids are telling you how expensive stuff is, you've got inflation that's real.
Yeah, amen to that. And again, the reason I've said it before, right? Inflation, this is the Fed put is over, right? The Fed could pivot in 18 because again, inflation wasn't an issue. The inflation is worse than the stock market crashing 30%. It just is. Inflation hits everyone. 70% of our economy lives paycheck to paycheck, and they're getting smoked.
Yeah. And why is it worse? So let's talk about that, because people's discretionary spending, we're a consumer driven economy.
Yep.
So if you can't spend more, then you cut back, which cuts back on companies' earnings, which drops valuations, which cuts back on production, which eventually leads to layoffs. And we have a broken, labor market right now. But there are layoffs happening in a lot of sectors of the industry. So eventually that'll catch up. And the Fed can't pivot because guess what? Japan, Turkey, look what's going on from constant low interest rate in QE. Japan's lost decade. They had so much QE out there and so much low interest rate policy that it stagflated their growth for like 10 years. They could not grow. So, that's what happens. And then Turkey, hyperinflation. So, I mean, their CPI came in at 73%.
Crazy. Because that is hyperinflation, folks, right there. 73% hyperinflation.
Right. Because they kept interest rates low and they haven't done the work of raising rates. And, the last time inflation was this high was 40 years ago. And that's when Paul Volcker came in and took rates from 10 to 20. He doubled the Fed fund rates. Now, there's a big difference going from 10 to 20 when the economy was very different back then. And it wasn't as big of a deal or huge of an impact as it is now in such an over-levered, financial engineered system like we have now, from a zero interest rate policy where it's been levered up 100 times versus a 10% interest rate policy that was levered up maybe 10 times.
Yeah.
You got to remember, leverage wasn't, at levels back then like they are now. Valuations weren't at levels back then like they are now. So, going from 10 to 20, look at the damage that did and where we're at now. That's why you're seeing such a big adjustment going from 0 to like, where are we at? 1.25 or something?
We're not even there yet. We're at 0.75.
0.75. Yeah. I mean,
it's crazy.
And the Fed target is like 3.
Yeah, exactly. So one of the things that wrap this one up is I think the Fed has to get the funds rate ultimately up to 4% sometime next year. I think that feels kind of the upper bound. They have to get restrictive. They can't get this whole idea. Let's get to neutral. I think they got to go beyond neutral. I've been pegging 4%. I don't know if you've given this any thought, but they're not going to 10. They're not going to 20. I think they go from 0 to 4. And I think that breaks enough stuff and causes a hard landing. What do you think?
Yeah. There's no way to soft land this thing just because, market's going to sell off, that's wealth destruction. Housing is going to, correct. That's wealth destruction. But consumer, goods and services and staples is even worse. If people can't buy food, if they can't buy gas to get themselves to work, you think the baby food thing was a big deal? People rising up? Yeah. You wait till somebody can't put food on the table because it's costing too much, or they can't buy medicine, or they can't, that is civil unrest that starts to happen. I'm not talking about like people picking up guns or anything. I'm talking about just crying out and, marching and things like that. I mean, that's when you see real trouble in the streets. And that's, what they're trying to avoid because it's real. Yeah, it's real. I mean, you're talking about Depression era stuff where you have food lines and, things like that. And I don't think this country can have a depression just because, our economy is so big and things like that. But the Fed has to let it play out now. That can has been kicked to the point to where there's nothing they can do other than try to land it softly. And all right, so what's a soft landing? What does that mean? Mm-hmm. That means easing into things so that everything doesn't crash all at the same time. Mm-hmm. That's what a soft landing means. So the question is, how slow can they go? Because inflation has not peaked. Maybe a couple little things, but you and me and everybody watching this knows ain't nothing coming down. It's continuing to go up. So they have to get that under control. And the only way to do that is to be more aggressive. Now, there are some economists saying that there is nothing the Fed can do to control inflation because they can't control oil. Mm-hmm. They can't affect that. There's really nothing they can do to affect food. That's a supply chain issue and a labor market issue. They can't control those two things. There's nothing they can do about the labor market. Mm. So what can they really control when it comes to inflation? Assets. That's really it.
Yeah. Oh, the next couple of years are going to be interesting. We're going to talk about that in video number 3, the opportunity ahead of us for the ones that are prepared. But before we do, Greg, where can people find you?
Yeah, gregdickerson.com. That's where all my info is. Go check it out.
Thanks, buddy.